Good evening, everyone, and welcome to this Your Market Navigator series. Today, we have a very special guest, our Managing Director and CEO, Mr. Balasubramanian. And I'm sure Balasa doesn't need much of an introduction to all our partners and our investors community. So without taking much time there, welcome, sir, to this session, and looking forward to have a conversation with you and learn from your insights, both in terms of markets, and also in terms of the industry trends that you are seeing, etc. But we'll just break it into this, split into these two parts. To start with, your wealth of experience, very, very rich experience in the fund management industry and the capital market in general. And you have seen many, many cycles, many bull markets and bear markets over the last 30 years or so that you have been associated with capital market. So this 2020 has been a very, very challenging and unique year for us. So how do you see this economic and market cycle that has played out in 2020 compared to the rest of the cycles that you would have seen over many years?
Yeah, thanks, Bhavdeep, for this setting the ball rolling, and also having this market navigator every Wednesday religiously last so many months. So my first compliment to you and the team for creating a knowledge platform for all our viewers and investors and distributors.
Thank you.
So, with respect to the 2020, definitely this is unique from the earlier thing that we have seen. Of course, one of the most repeated name nowadays, one of course is pandemic, and second is unprecedented. I think all of us use this unprecedented many number of times. Initially, we were doing it forcefully because everybody was using it globally. Then suddenly now became a norm. Everybody has been using the unprecedented. And pandemic also now become a new word to be used quite frequently. So this was not the case in the previous many cycles. And interestingly, the Harshit Mehta whole scam has come out in the form of a documentary today. So interestingly, my own family members are asking me to watch it. Mm-hmm. And I told both my son and daughter, I don't need to watch it because I was there part of the stock market that time and sitting closer to the exchange. Mm-hmm. And therefore, I don't need to watch it. I know every name. And somebody took the names very interestingly. These are the names which has been given. I said, they are the real names. So who have been quoted in the episode of Harshit Mehta 6 series or 5 series, all the names are real names. Mm-hmm. So then that's why I was explaining to them. And the point that I'm trying to drive is all the previous one, where some of them are domestic in nature, some of them are global in nature. And this pandemic is only one. It's a completely universal, across the universe, same problem. And therefore, we have seen this is something different from rest of the things. And second is, it's related to the health. Therefore, I mean, no humankind would feel that people should have problems, and therefore, people should not have, should they face this kind of problem, then fixing a solution for the people, at least feel pity or empathy, is something which was not the case in the past. Whereas this one is completely related to the humankind in the universe, therefore is completely different kind of problem altogether. But having seen this, I think if you look at historically, this kind of problem comes in different nature. Because one thing I learned in the marketplace, one of the leading stockbrokers used to always tell me, whenever I used to ask him, one Mr. Pankaj Bhai, so I used to ask him, Pankaj Bhai, market kya lagta hai, kabhi teji aayenge, kabhi mande aayenge. He always used to give me one simple answer, bola kabhi market girne ka time bol ke nahi aayega, aur badhne ka time bol ke nahi aayega. I think both were the single answer he used to always give. Very old gentleman, been in the market for last 40-45 years. This one single simple answer is to come. That always used to make me think that bull and bear market is part and parcel of any market. The reason will never tell you on coming upfront. The reason always come only if the reason occurs, and then you suddenly start seeing the market reacting and so on and so forth. Therefore, the 2020 thing is definitely is to put your economy into a complete lockdown. Then naturally, the market is driven by hopes and optimism. First, driven by hopes and optimism. Then comes the earnings. It's not the earning comes first, then hope and optimism comes later. Hope and optimism comes first, and then comes the earnings. and then it's the continuous earning sustainability that comes. So that's the way the whole market functions. Therefore, I would assume while 2020 is different from all the past the event that happened and impacted the market, whereas 2020 is also different from the way regulators have been reacting to this universally, uniformly, and finding a solution across the board. And that, in my view, has come on the basis of the past learnings. That's why we have seen a big pullback in the market. It was largely on account of that. Therefore, from the behavior of the market point of view, it remains more or less the same. There is a knee-jerk reaction that makes people start believing that that's the end of the world. And whenever there is a feeling that the end of the world, that's the time market always provides an opportunity, which has been one of my key learning. But for that, I would assume that one would not have remained in the system for long in the MF industry. As well as we as a business, we have been part of our business for the last 15 years, 12 years, or 14 years. And each of the hurdles we come across and find the solutions. As long as we have the visibility to withstand those kind of pressures and withstand this kind of volatility, then we'll be able to build, knowing very well there are many unknowns in which we are dealing with on a daily basis.
Yeah, so interesting, and the fact that तेजी और मंदी दोनों बोल के नहीं आता है, anything that is so true and so well experienced by all of us in 2020, because post March no one would have anticipated that after such a sharp fall, and given that as you rightly mentioned, the pandemic has been a new phenomena this time, unprecedented in many ways, and it is being unprecedented times being talked as an unprecedented event. So you are so right on that. But what has surprised many investors and I mean generally in the marketplace is the sharpness of this rally. So do you think that it's kind of likely to sort of continue from here, or you think it's really running ahead of its economic fundamentals, and therefore investors should go cautious at this point in time? So your take on that?
I think this question of cautious is actually came even during the pandemic beginning of time. So the market fell and everybody was cautious. I myself used to get call from some of the known investors, middle class investors who had put their retired money in equity in the 2017-18 as part of allocation. And suddenly they realized their own investment fixed income have done better. Their investment in equity has not done that badly, not that done well. Therefore, they're all trying to reallocate the money during that fall period. Some of the investors, of course, are private too. They had an access to me, and they used to call me directly. And one answer I used to always give: wait for some time, don't panic, don't do anything. And it's not time to be cautious, not time to be panicking. And even if you don't make fresh investment, I'm still okay. But at least don't make your existing investments, which can and such investors today are happy having held on to their investment. And the market, of course, has gone up because you cannot underestimate sometimes the power of money, which is nothing but liquidity. And you also cannot underestimate the power of the regulator. The power of the regulator, they have all the tools in their hand. It's like Brahmastra, if somebody is using it, the naturally will have its own impact. And the same way, I think both the government, not just India, I'm saying globally, so they have been using multiple Brahmastras that ensure that economy doesn't suffer. Or maybe to the extent it should suffer, at the same time, it should actually give some kind of hope for things to come back. So that remains. Even today also, the hope and optimism remains. So now, regulators also understood that the need for an ongoing correction, ongoing push, till such time they see everybody starts saying car sales number come back normal, these job losses come back normal, and then people start thinking actually that every shops in the country are full with people with coming back with buying behavior and so on and so forth. Till such time we see such thing happening. I think regulators and the central bankers will continue to focus on how do we actually revive the growth back to normal. Therefore, which in my view will be another 1 year, 6 months period that we have to watch out. Having said that, market having now seen it quite substantially, obvious question which comes in everybody's mind, valuation. Because the easy answer that it can always, easy question which everybody can ask, if you don't have any other question to ask, is a valuation. See, valuation is something neither you understand nor I understand. Because valuation is actually how do you perceive it? It's a perception. So valuation, you put a number and then put it divided by something, or add it up something, multiply something and see it. You can say its valuation is high, valuation is low. My own understanding in the last many years of experience, again, it came post this 1999 crisis. It also came as part of my own reading and understanding post 2009 crisis. Even 2012 when there was a slowdown. Valuation in a market which is likely to grow at certain rate of interest, certain rate of growth, then valuation is something should be looked at in that context. If the growth is not going to come back, the hope for growth to come back is low, then naturally I need to be worried about the market momentum. If the hope for growth to come back is relatively high, then naturally it's combined with the optimism, therefore the market will remain bullish. So I think there are enough tools and rooms are being fed in, or maybe room being created for one to be bullish. So the question is how far, how much? That none of us will be able to answer that. Because who will try to answer these questions in the past as well, I don't think anybody would have got it right from the point of view of predicting what could have happened that period of time, or what could happen that period of time. But definitely the tools that are now being created to justify the bullish view, to justify the optimism, combined with some growth could come back the next year. Therefore, that remains. Therefore, I would assume from a market point of view, as the real growth comes, you'll probably see the market tapering off. So till such time the growth comes back, the hope will continue to keep the market bullishness high. But having said that, the market I always seen people find ways and means of doing a sector rotation. I think one of the famous theme at this point of time going around is a sectoral rotation from money manager's point of view. You push up something, then you find others cheaper, or others maybe worthwhile considering. That's why I think the whole sector participates. Therefore, from the market point of view, it is only the question of when for somebody to participate in the growth. It's not the question of whether at all. So whether at all question doesn't arise. It's only the question of when one will be able to participate. So I think that's something which I have realized. Give a simple example. 1.5 years back, when somebody had invested in pharma fund, he would have cursed himself. Exactly 1.5 years back, he would have cursed himself, saying, why did I put money in pharma fund, which has given me 3 years of negative return? And I have seen this question myself. When Mahesh and the team, and from an equity team, when they identified Cipla at a price of 300 rupees, exactly at a price of 300 rupees, we used to have a lot of discussions in our team. And Mahesh, even I used to ask questions, Mahesh, Cipla kind of company that never made money for shareholders in the past. So why do you want to look at that? He had a very strong argument along with the conviction coming from our pharma analyst, Dawal. And very high convictions he had. As a fund house, took large exposure to Cipla at that point of time. In fact, I was a bit worried in order to revive our investment performance. So if we own Cipla kind of companies, will we be able to do that or not? So I had my own mind, a corner of mind. But of course, the conviction of both Mahesh and conviction of Dawal Shah, I think both of them made it really work. And we have seen how the stocks are done well. The reason why I'm taking Cipla as an example and pharma as an example, something which you were thinking about 1.5 years back, if the sector is not given return for a 3-year period, the same sector is given for 1.5 years period, substantially higher return, compensating for all the 3 years of underperformance. So that is the way the market provides an opportunity for every sector to perform, as long as the sectors do have care for governance, care for other related stuff like ESG and all is coming in. As long as they actually score those points, and then the companies has not given return, but suddenly it can. Today morning, I was just saying a global report Suddenly the iron ore prices, which is under tremendous pressure for the last so many number of years, suddenly iron ore prices come back. Therefore, somebody who is operating in the space will suddenly start getting the benefit. May not be in the long run, but at least temporarily. So that's how the market functions. So as long as we keep that in mind and being conscious of these things rather than cautious. I think being conscious of what these things from money managers' point of view, being conscious of these things from investors' point of view, or being conscious of these things from distributors' point of view, then the cautions or cautious can actually replace with the consciousness. And that's something which in my view can give a better output. That consciousness, that awareness, but at least will remove my fear, will remove my caution to a more of pragmatic approach to the investment world and approaching to the market investing. And therefore it gives me better success.
You're right. Fair. I think it's particularly the last example that you give on the pharma, etc., pharma and the Cipla one is quite interesting, because those investors who had climbed the wall of worry 1.5 years back would have reaped the benefit now. So pretty much like that. And I think you gave a couple of very compelling reasons as well, as known, but I think you explained it differently. Is the flows, first of all, the power of money or power of liquidity that you talked about. Another thing that you talked about was the response of the policymakers and the commitment of policymakers for reviving growth in India and elsewhere. So I think these are enough reasons for someone to really look at being investors. So I think as I hear your key message is whether you add or not is a separate question, but stay invested for the equity exposure that you currently have. So stay invested to me has been a key kind of phrase from your kind of narrative that you just shared. Right?
I just want to reiterate, since you mentioned about stay invested, Bhavdeep. I think stay invested is something, in my view, should be the biggest justice I can make to the investors, to the investing public at large. The biggest mistakes ever, in my view, made in the past is not about not investing. So not investing, of course, is one risk which increasingly, rather interestingly, one Mr. A.P. Korean, who used to be part of our mutual fund industries and AMFI chairman in the past, he used to always use this word, bring that wisdom. That not investing in equity is also risky. That's what he used to say. While you agree with that point of view, but when you have built your portfolio with great difficulty, and then suddenly you realize and you review your portfolio, especially at a time where a pandemic kind of thing happens, and such a sharp fall, naturally your portfolio look bad. And when your portfolio look bad, is it the right time to actually to look at redeeming? And that's something I think most of the people make those mistakes.
Yeah,
I think when we always build for some kind of purpose, build some kind of objective, and those objectives at the time of building the purpose and objective, it is always a known fact that market may go through ups and downs. It may actually meet with some kind of accidents, and the overall sentiment could get derailed. At the same time, things would come back. And the power of equities always comes with one bull market only. Because unless you ride to the entire bull market and bear market, and then you are reaping the benefit of the purpose for which you are putting in money actually will get lost. So I'll give you one simple example. When we launched our banking and financial risk fund in 2014, 13 and 14, that period, 2014 we did, October 2014 if I'm not wrong.
13.
And 13.
2013. Yeah.
2013. And then May 2014, the election happened. That particular year, market gave such a high return. Unless somebody has remained invested pre that period, and then post that period, you will not have got this return in his portfolio. Therefore, staying invested, even if you don't do anything, incremental is fine. And then staying invested should be the mantra that everyone should apply. Second question which I always ask is, okay, now I redeem and go, and where do I go? So then is there any option for me to go which can compensate me for either the loss that I occurred, or I am going to get some substantial higher return somewhere else? Because somebody is actually looking at that model, then he has to be extremely sure that where he is going to make the investment. if he's going to make the investment saying somebody is performing very well, therefore I go and make an investment, clearly, again, I have seen a good performance followed by a little bit of mediocre performance, at times poor performance. But as long as there is equal commitment from the money managers and fundos like us, where we fight back, right? We also have to fight back to ensure we come back on track. Every individual, for that matter, either you or me, all of us fight back to ensure that we provide the necessary good experience as the objective was set for us. So when we are actually putting the equal amount of fight, then there has to be, the fight has to be supported by the fight. Yeah, if the fight is supported by the fight and then have some kind of passion, then naturally the stay invested actually will benefit quite a lot on such kind of theme and concept. So this is something I realized. Staying invested gives a multiple ways. I think that's, if you ask me, one of the bigger service I can do to my investors and as well as our distribution partners is to give the mantra of staying invested. If not, make fresh investments. Yeah, fresh investments has to go through the model of which is the one you should go and so on and so forth. But in the existing investments, I don't have the challenge. It's more of getting myself convinced that staying invested actually is the key. And all of us are, when we build a model, always build like that, whether it is from a working point of view, whether it's investing in any startup ventures, whether investing in, because nobody investing in a startup venture for 1 year, 3 years. It's always build it for 10-year period. So same concept exists on asset allocations or investing in equity mutual funds. Therefore, staying invested is actually one of the best services I can provide to the investors. If not, I'm not able to convince the investors to put more money.
So thank you for saying that, because I think a lot of investors and our partners would have drawn some insights from this particular answer, simply because we have seen that on each high, right from 8,500 or 9,000 Nifty level all the way till date, whenever there is a rise in market, people have been selling. And as you rightly said, wealth creation requires as much about investing in equity as much about not exiting equity early. And I think the same thing people did in 2003 to 2007 cycle also, in terms of exiting early and then not returning into the market. So I think for wealth creation, staying put is really, really important. And thank you for re-emphasizing that. On the economy and the recovery side, sir, there are a lot of, if you can just share some ideas, because many people have, many experts have said that India post-pandemic is a much bigger and better proposition, economic proposition, because of whatever has happened, whether it's China plus one strategy, for example, or the US elections, and therefore the EMs getting favored and things like that. And some of the initiatives that our government itself has taken, the RBI very proactive response to this crisis, etc. So with all these factors, people are experts do have a view that India is a stronger proposition now than before. So your view on that, and therefore the prospects for recovery.
No, definitely, I think the prospects of recovery is rising, Bhavdeep, for one simple reason. What we have seen pre-pandemic, because I used to run to Delhi very frequently post ILFS crisis. Because all of us don't want crisis, and everyone wants stability in the financial market, and nobody wants to derail the growth. At that point of time, knowing very well financial market crisis will derail the growth, the government was moving a little bit slow at that point of time. Whereas what we saw during that period, and then what we saw during the pandemic period, is completely a different approach which the government has taken. Today, the government is willing to take any amount of steps, even if it means at the cost of fiscal, even if it means at the cost of interest rates coming down and so on and so forth, which is nothing but a saver's interest is not taken care by cutting the interest rates. So they have taken many steps, which in my view, it's actually one of the biggest strength that they have created in terms of approach and attitude and the mindset of the government to drive such things. And second is the biggest, the driver of Indian economy is agriculture and rural economy. I was just reading, interestingly, it's just a coincidence for this conference. So somebody who has been extremely bearish on India for quite some time in one of the international research agency. So I've been tracking them closely. And today I saw it interestingly that he is talking about very high about India and creating a bullish story on India. Purely on the base of $7 billion of inflow that has come in the last few months into India during the pandemic period. At the same time, he's predicting actually huge flows to come in India for one simple reason. The structural reform in India continues. Agriculture growth is likely to be far better. They even talking about agriculture would be given a higher impetus and higher focus from the government for making it corporate farming kind of things, so that the farmers get to benefit. Corporates and institutionalized kind of format also comes in the agriculture space. In the real estate space, where they were not paying a single attention in the past during the pandemic, where during the 2008 crisis period, they felt real estate is something which is not industry to be supported, but now it's the reverse. So now the real estate sector is being given a sufficient support, one from the consumer point of view, second from the economic interest point of view. In my view, all such things, there's a change of track. There's a change of track from a highly conservative track to a moderate to a aggressive track that is coming in, which in my view will continue for next few months and few years. If that comes, actually one of the biggest mantra, improved compliance on the GST, supported by recovery growth coming back the next year, also supported by Reserve Bank of India, a proactive, pragmatic governor who is sitting on Reserve Bank of India today, whose term is there for another 2 years. In my view, that combination would bring in a greater promising future for India. Which, in my view, what will happen on the base of this? You'll find money coming from overseas would be substantially higher than what you have seen in the last many number of years. If that comes, I think it can fuel. A very few examples I will give you. When the domestic mutual industry is seeing redemptions, they are seeing this is an opportunity and bringing in money into the country. And that's the way I think they see it. They see the mutual funds seeing redemptions is an opportunity for me. That's a good time to go and buy stocks at good price. That's where the foreign money is coming. I would assume this cycle would become a new normal for the next 10 years if you have to take it. And if we take the little longer term bull period, probably I would say what we are seeing in Japan today, almost 25 years of Mandi, and today Japan is the single largest recipient of foreign flows the last 1 year, last 6 months of $26 billion during the last 6 month period. The next comes India, about $7 billion. So which in my view would come purely because of the political stability, structural reforms continuing, big focus on rural growth. On all these factors, my view will actually uplift the sentiment towards India. Therefore, we as a domestic investor should tend to benefit. Again, I repeat, by staying invested, if not investing more.
Fair enough. So perfect. And I think that example of what happened in Japan and the way they kind of have been receiving now foreign flows, etc., and how India is kind of very closely being number 2 to them. And you just talked about, I think, the structural reforms and other factors which could potentially drive growth and recovery, not only for the next couple of years, but you are saying for the next 1 decade. And that makes a very strong case for staying invested. So you talked about market volatility, market and economic cycles both. Now talking about as an MD and CEO, as a business head of a large AMC like ABSLAMC, now you're also dealing with one, or we all deal with this, fund performance cycle as well. And we have had a phenomenal run since 2013 till date. For example, our equity AUM is up by about 10 times as we speak now. But again, there were 2 phases of that, 2013 to 2017-18 financial year, and then previous 2 calendar years, which is 18 and 19. And again, in 2020, we are back very, very strongly in equity. So would you like to kind of share with our investors and partners a perspective on how important is fund performance consistency to us, and what do we really do about it, both in terms of processes and the risk management practices that we have?
Yeah, I think interesting about the, I think you mentioned about 2013, since then how we bounce back. I remember 2006, 7, 8, the 9 period was the best year. on our investment performance. I still remember nowadays awards and recognitions cannot be made public. Those period, CNBC had recognized ABSLAMC Mutual Fund consecutive year, one good market and a bad market as the Fund of the Year award, both on equity and fixed income performance. And it was a true consecutive year. Correct.
2007 and 8, right?
2007 and 8. 2007 was a good period. 2008 was a bad period.
Correct.
So immediately after Lehman Brothers crisis. So that something gave us the confidence that what we are as a fund house capable of doing, it's good. People are extremely committed, and they have their own internal process they built in. I think at each passing stages, I can only say that our way of looking at companies, we are looking at process. So when an investment side is not about only spotting winner is very important. It's not about just only how much you're earning is important. It's also about the process that you build in our asset allocations, sector allocations, and get the best out of every analyst in line with what is the offer document objective of each of the schemes. That has been one of the single most successful mantra. And one of the biggest success we brought in is like making front end equity. I still remember a 7 crores fund going up to almost 22,000 crores in the peak. It is close to about 18,000 crores, the large cap focus fund. That came pure on the basis of the discipline that as a fund house built in as part of the investment process, which is a combination of spotting opportunity on an ongoing basis, ensure those opportunities are spotted or are owned in the portfolio on a timely basis. At the same time, you hold your conviction to build your portfolio in the long-term thing. I think one of the things that we got caught, you got your call 5 years right, especially not owning public sector banks in our portfolio. I remember the discussion that we used to have. Mahesh and the team did not want to own public sector in the portfolio for long, given the fact that they had different kind of problems to handle with. Therefore, the complete bets were on taking exposure to Bajaj, GFC, and ICICI Bank kind of things. But of course, when the government does some initiatives, and then the stock actually tend to move up as a result of those government initiatives, naturally you have to do a portfolio course correction. And that is where you actually dilute your conviction a bit and then go for it. If you ask me, the first accident that happened in 2018, people on the back of that. But for that accident, I think we would have sustained our performance quite nicely, even during the period of 18-19. Now, having realized, so another day there is a course correction. So have you got the mindset to do a course correction? Yes. Do you have process to do a course corrections? Yes. And do you have commitment to actually do the course corrections? Yes. Which comes in the form of accepting, yes, I need to get better. This is not my style of operating. Therefore, we need to work towards what is that 5 things that I need to do to get the performance back. In fact, that's what we did in the case of equity bounce back. People ask me actually what are the things that I have done for the equity performance to come back. We went back to the basics and then what we are doing right in the past and simply repeat those rights and ensure that we bring in a collective contribution from the whole team and ensure that we do all the 3 things right. Spotting opportunities, putting in our portfolio sufficiently, and then ensure that we track it both in some sectors as well as on stocks, and then own them as a proportion of your liking in the portfolios and ensure the portfolio is reasonably well diversified. Don't take one-sided risk and taking a very high exposure. Sometimes taking constant exposure can give you a substantial higher return. At the same time, it can also give you consistently a poor performance. I'll give you a simple example. Avenue Supermart was super stocks for almost 3-4 years. But the last 2 years could not give much return. Yeah, everyone goes through that cycle. So that's something which I think as a fund house have realized and have made the course correction in the portfolio. That is why our equity performance, if you see, right from the funds that are being managed directly by Mahesh and the funds that are supervised by Mahesh as a leader, as well as the other funds that are being managed by each of the managers, have brought those alignment, understanding of the concept that is mentioned and sticking to the concept. That's why I think the company are walking the talk. The same way on the fixed income, we do go through some cycles of ups and downs. But as long as the team is realizing that which is the path in which I was walking, I was doing very well, this path got deviated because of circumstances, then are able to do the course correction and come back and then walk the path for which you are meant for walking. And then those course corrections, that's the way we have built it. I'm happy to, of course, say that that process that you have built as part of the investment, that gives me the confidence that we will be able to give that sustainable experience that for which we are known for, consistent experience for which we are known for, and that's something in my view we will be able to do that. That comes pure on the base of the last 1.5 years of this thing which has come back in terms of performance, both on a stock selection. Otherwise, I want to take the example of Cipla. The Cipla took example, that's spotting the opportunity at the right time, at the right price, and have it as part of the portfolios. And then similar success story we create on many other names so that we're able to bring that experience to the investors.
I think that's very well put. That 2020 comeback in equity funds for us at ABSLAMC has roots in, as you mentioned, three elements. One is the course correction itself, but the mindset for course correction, the processes for course correction, and the commitment for course correction. I think that is my key takeaway from whatever you just explained right now, and that's very well put. That as an AMC, we are committed to delivering consistent long-term performance to our investors. And the source of that is this being nimble-footed in terms of course correcting wherever the deviations happen. So thank you for that, sir. Now let's move to funds side. And just want to talk about 2-3 big themes. In fact, we usually have our fund managers and analysts, also CIOs, to talk about funds. So we'll not get specifically into the fund portfolio and fund performance, etc. But there are two debates which have been kind of happening. One is about the active investing versus passive investing, with large cap funds versus ETFs. So what do you think as an industry leader, as a business leader in AMC, and with such a vintage in the capital market? So you think that it's for real and people should incrementally be taking exposure only in ETFs, or you think large caps still have or the active funds still have a role to play in investors' portfolio?
Yeah, I think the way Bhavdeep one should look at this is two segments are competitive to each other or complement to each other. And one of my biggest learning when I was in Harvard program, then met with the biggest service provider in the world, which is a BlackRock co-founder and co-CEO. When I met him, I asked the same questions. I asked him about this ETF versus this. He gave me a beautiful answer that both of them are complement each other. It is our duty to offer variety of product offerings to the investors, and it is nowhere it has to be sold saying this will do better than the other one will do better than the other one, and therefore passive versus the actively managed funds, both have to go hand in hand. Therefore, offering the product and solution to the customers has to be holistic in nature rather than keeping selfish in nature of, okay, this is where I'm getting a larger fees, therefore I need to sell this. But having said this, and the money managers in India like today, they always get a great opportunity to outperform the market. I'll give you one simple example. I think in our own presentation, we keep putting it. There's only one index which is still trading at a discount to the 2018 peak. It is not Sensex. It is not Nifty. It is only a small and mid-cap index. They're still trading at a discount. Having seen a substantial rise in the market, sentiment, optimism, and also towards investing in equity, everybody says invest in equity. Despite such conviction, small and mid-caps have still not come back to the extent should have come back. Is it an India phenomena? No. It's actually a global phenomenon. So we think actually everything is India phenomena. It's not an India phenomena. Because globally also a similar kind of phenomenon is there. In fact, if you ask me in the last 3-4 weeks, there has been a increased traction is being seen for the small and mid cap. And also there is increased growing conviction coming from small boutique money manager firms who now starts looking at companies in the small and mid cap space for them to generate not alpha, to generate unique investment opportunities that they are identifying. Yeah, similar opportunities exist in India. Therefore, a money manager who is a large cap focused money manager, one of his mandates is actually look at outperforming the index by about 2 to 3%. This is what actually untold, unstated objective that he has in mind. Again, nobody has got an objective in his mind that I will continue to underperform. His objective is always to beat the benchmark by 1 or 2%. Okay. In fact, if you ask adjusted for expenses at gross level, he'll be of course beating the benchmark. But at the end of the day, he has to beat the benchmark plus the expenses plus something. which in my way can always occur if we have a reasonably good, sustained bull market that we see in the small and mid cap space, which in my view is not far away. And if that again comes and goes, I think if everyone remembers, till 2018, small and mid cap portfolio have done extremely well.
Yeah.
And when the crisis happens, market of course become cautious, and that's why I think we saw a sell-off in the mid and small cap space. When the optimism returns, it comes in the broad market first, then it takes along with that other sectors and stocks and the lower market cap. So that's where we see the performance coming back. I would assume the money managers generating alpha is not a challenge. It will come back. But having said that, from a customer point of view, I need to be fair. As a manufacturer point of view, you have to be fair in providing products that are complementary to each other, so that we are able to do a justice to the customer in terms of asset allocation. And that is where it comes a mix of actively managed funds, some bit of passively managed funds, and both the combinations provides a greater experience to the investors, rather than just taking this is good, this is not good, on the basis of which we take a call.
Fair enough. So I think essentially you meant to say that the complement, both these strategies or both these portfolios have a complementary role to play in investors' portfolio, and not competing or one over the other strategy. So that's a point well taken. And as you rightly mentioned, in normal bull market or normal situation where the polarization which happened in last couple of years, if that doesn't happen, then large caps have a greater potential to outperform their respective benchmarks, and that time is not far away, is what you mentioned. So that leads me to another question, which is another big debate of value versus growth. And as you right, I think touched upon it a little bit, but last few years, what we have seen is last 10 years actually, the DMs have done better than emerging markets, large caps have done better than small and mid caps. Growth as a strategy has done better than value, etc. And then there are increasing number of experts also of the belief that now this theme could actually reverse, and emerging markets could do better, value could do better than growth, and small and mid caps could kind of grow faster than large caps. So in the context of some of the funds that we run, for example, equity PSU equity fund that we have, dividend yield fund that we have, which has not done very well as it did in previous cycles. So for the last 7-8 years, I think our dividend yield as a category has not done well. You think the time for these kind of strategies is back, or people are better advised to stay put in the diversified funds or small and mid cap funds?
Yeah, I think interesting about this kind of debate and discussion always comes only when the alternate investment opportunity becomes smaller and smaller. So when I mean alternate investment opportunity becomes smaller and smaller, that is coming from where? What is the source of that concern? Is coming from the interest rates. Whenever the interest rates are low, which is not acceptable to you as a saver, and is not sufficient to meet your needs and desire and then the requirement, then actually look for alternate investment avenues. This is where I think value theme comes into play. The Birla Dividend Yield Plus comes into play only on the basis of that. Of course, in the case of 2002, when we launched the Birla Dividend Yield Plus, there was a time where we used to find companies that used to give about 11% dividend yield compared to 4% bond yields. So 4 versus 11, what will you choose? The natural 11. Only the 11 is associated with the stock price falling, whereas the 4 also is associated with the stock price falling. Because the security prices can fall if the 4 becomes 6. If the interest rate of 4 becomes 6, the security prices could fall, and therefore you lose money. If the 11% dividend yielding comes, okay, 11 keeps coming in, but the stock price falls, if there is no growth in the company, then actually you also lose. But the question is, what will do better than the other one? That's the question is there. Therefore, in such a scenario, naturally, dividend yielding companies can do better. So one of the assumptions which I'm making, in times like today, the markets always rewards structurally high growth sector consistently for a long period of time, like pharma or IT or even the consumer durable companies. They're all structurally, as a business by nature, structurally high growth companies, and they are building a business for the next 100 years. Therefore, they will have a sustained bull market. That's where the portfolio manager will look at it. That's a high growth company, structurally high growth companies. Then second is actually the cyclical companies. Cyclical can be of domestic cyclical or cyclical can be of global cyclicals. And these are the companies in which you find valuation at times becomes attractive.
Very attractive.
At times you will find the dividend yielding become attractive, and that's why the portfolios are built. So there is a merit even for PSUs. Today, the way in which the government of India is moving on public sector reforms, this is the first time where all right noises are being made with respect to even making some of the public sector banks privatized, and now trying to get corporate in the banking sectors. These are actually, in my view, mother of all reforms if it happens. And BPCL divestment could potentially become the mother of all reforms. If the government of India is without making a noise, in the normal course of time, this could be called as mother of reforms. Today, nobody is paying attention because nobody actually are happy with the way the stocks have performed in the last 2 years. Therefore, they think I will continue to burn my finger. But the way I see is, if these things get materialized one by one, you will see that interest levels in this sector is rising. At the end of the day, market is a great leveler. See, it doesn't reward one segment continuously for too long period. At the same time, it does punish one sector for a prolonged period. And as long as things come back normal, that prolonged period underperformance also comes back in a matter of 1 to 1.5 2 years period. But not sustained beyond that. But at least 1.5 period come back. My view is some of these powerful themes in the value play could come back. And as a mutual funds, we have this kind of product. We've gone through the pain period of remaining underperforming to the investors' point of view in these kind of funds. And as I always say, sabka din aata hai. Therefore, the value theme also, in my view, has come back today. Therefore, it also comes as part of the asset allocation rather than single allocation.
Perfect. So I think the mean reversion essentially that you talked about, that asset classes mean revert, and for prolonged underperformance by this kind of strategies, there is a time that now is the time to kind of allocate a part of the portfolio towards this kind of value strategies. And just another key strategy that kind of making a lot of noise globally and also in India is this ESG theme. So it's not only just as a portfolio or a portfolio strategy, but generally as an investment theme, it is getting a lot of traction, a lot of flows globally and also in India. What do you think its relevance is? One as a portfolio strategy, and otherwise generally as an investment style itself. So do you think it's kind of there for a long haul, or it's just another portfolio strategy which has its day these days, but only will be short-lived?
Yeah, I think interestingly, Pradeep, is even we ourselves are looking at launching ESG fund. Yeah. See, it's not about the fund alone; it's also about your fund style of investing.
Right.
And historically, every money manager is known for chasing growth at any price. And today, that definition is changing. While growth at reasonable price, what you can call it, and at the same time, growth coming from a companies who does not protect environment, does not make any social contribution, does not have a good governance, those get knocked off. That has now become is the pressure on companies to perform. In taking into account these aspects, even the fact that globally environmental become the care for the environment, the care for social cause, the care for governance, they're all now becoming the way of going ahead in terms of business model. I mean, all of us as an individual have to pay attention to these three themes. So when such kind of thing happens, it also enhances the responsibility on people like money managers, as an advisors, also look at as a justice to the this kind of concept. So that is why it is emerging, and most of the people also now started feeling it is the responsibility of money managers who actually put public money into the use should go to the right set of companies who runs a concept taking into account this kind of strategy without, for example, child labor employing or polluting environment. If some kind of company will go and make an investment, I may make money in short term. The question is, am I doing a justice for such kind of companies by giving my resources, which otherwise could have gone allocated somewhere else? Therefore, the money which has been chasing the whole market, I think as we move forward, the money will chase to those companies who are actually ESG compliance, which essentially means ESG compliance companies, let us assuming they were trading at a average P multiple of the last 10 years, and assuming 20 times P multiples. then naturally the money is moving towards that sectors. 20 will become 24 or 20 will become 25. As long as ESG compliance is going to remain sustainable. If the sustainability of ESG compliance is going to remain longer, then naturally I'll continue to give a better valuation and therefore the better growth and better experience for the investors. So that is the way I think the whole concept is moving towards globally. And India too, of course, is emerging. I would assume most of the companies who are not compliant with this, they'll also work towards ways and means of getting into the space, except companies are already generating huge amount of profit, but by doing harm to the users, such as cigarette, they may have their own challenges. Even in India also, there are a lot of investors never used to invest in companies that creates that deals with the meats. And such kind of principles have always been there. If somewhat institutionalized, now the format is being put in place. Therefore, the more and more people will follow, rather than which was there in India earlier, more of religion-based investors who used to be followed these principles. Now it become a universal-based investment concept.
Yeah, that's very well put. So ESG essentially is a universal-based investing theme rather than just a narrow portfolio strategy. And therefore, as you rightly said, potentially it could kind of re-rate the entire ESG compliant set of companies, because most of the flows will go in that set of companies. So lastly, a couple of questions. We have about 10 minutes to go, and we just wanted to have your insights and your ideas in terms of industry trends. Now, one is on the fixed income side, we have seen a large amount of money flowing in both from corporates and individual set of customers over the last few months. Partly because the way equity markets also behave, and number two, because interest rates have fallen and therefore the past return looks quite attractive. So that's one trend that we are seeing. On the equity side, we are seeing that redemptions have been kind of on the rise. Even this month, we are all set as an industry to see more than 10,000 crore of net redemption on the equity side. And even SIP flows have been fairly volatile even at an industry level. So what's your kind of take on this the flows and the trends in the flows for all both the categories, equity and fixed income?
Yeah, I think trend is, of course, is the trend follows the past experience. That's what I have seen historically. The past experience is good. Then naturally people assume the past experience is going to get repeated, and therefore people actually make more investments or make less investment. And right now we are just juncture. After having seen such sharp fall in the month of March, there is a set of people who actually think that now it's the great opportunity for me to redeem. Therefore, they are just redeeming. Which is what I mentioned earlier. Staying invested is the mantra that one should apply. But having said that, these redemptions on a total size is about close to about less than a percentage, even below that, substantially lower than the size that we have. Therefore, these kind of things are obvious to come, whether it is in fixed income or in equity. And today, the confidence on fixed income is the highest, the confidence on equity is the lowest, because of the contra. I think if somebody looks at the fixed income the last 1 year, because the drop in interest rates is a double-digit return. Whereas in equity, of course, I have given double-digit return, but after seeing the fall, now coming a double-digit return for 1 year. Therefore, people think, let me encash it. This is, I think, that the concept in which people go. But given the fact that under-penetration is high, and given the fact only 3 crore investors are in mutual fund, and given the fact that the mutual fund SIHE, which I started as AMFI chairman, now of course being continued as an AMFI as a body by the new chairman, which I think is a great thing to create sustainable strategy to build mutual fund business. That's something, in my view, will bring in more and more customers into mutual funds. Awareness during the COVID period has gone up quite significantly for investing as a principle. Therefore, the more money will come. And the money in the hands of people, temporarily people have reservation to deploy. But once things come back to normal, people will come back to looking for opportunities. Therefore, the longer term, in my view, the mutual fund industries will remain one of the industries to grow, and equity specifically in asset class will remain one of the largest asset class to focus on. Having said that, fixed income, again, having seen the volatility in the credit market, etc., definitely fixed income will still continue to be one of the asset class to be part of the portfolio. Given the experience it gives on multiple number of occasions, which is better than the expectations. And maybe on few occasions, it would have fallen on the expectations that few should not be extended to deserted investment. The larger period in which you got your return expectations right, that should be your consideration rather than few accidents decides your consideration.
Perfect. And the last question, we have just 5 minutes to go. And last question is not to the Bala as a CEO, but Bala the investor. And how have you dealt with your portfolio in the post-pandemic era, both in terms of equity and fixed income? And therefore, what would be your advice to our investors and partners?
Yeah, I think over a period of time, Bhavdeep, me as an individual from a hyper investing style, I became a passive investor. When I mean passive investors, I have not chosen index funds. So my passive investing actually put your money in SIP and then allow it to remain where they are as part of mass allocation, with a higher allocation towards equity, with a higher allocation to smaller mid cap as a segment. Ultimately, in the long run, the potential of that segment to give substantially higher return than the broad market is high. So that is where I have now put it. So do I disturb this every now and then because the return is low and then try to keep moving here and there, which I have seen moving from one to other. It gives me a shorter term better experience. It does not guarantee you longer term good experience. Therefore, I have realized keep building your portfolio through the SIP and keep building your equity portfolios as long as the age is in favor, as long as you have a visibility of your own earning capability until your retirement age. Then you have a higher exposure to equity. The ability risk is high. That's the way I built it. I think more than direct equity, 100% of my money is in our own mutual funds across all the schemes. Having said that, you need to also have a balance, and which everybody does not have the luxury of choosing a fixed income product like PF. It's something which I have also chosen. Apart from investing in our own low duration kind of fund where I don't need to worry about whether interest rates going up or any other things that are happening. The low duration fund, I think you only rightly mentioned whenever a private conversation that we had, low duration fund is meant for longer duration. So some of my funds have actually come to low duration funds and remaining for a long period of time, and that itself give me a better experience on my portfolio allocation. So that's the way I've built it, which is nothing but that's why I use the word as passive, and don't look at my portfolios and valuation on a day-to-day basis, but focus on where your money is invested. Am I convinced on that investment that I have made for generating my longer term wealth? And as long as that conviction is there, I stay invested without looking at how your portfolio is performing. In my view, if you are blind to your portfolios, 90-90% of the time you will do extremely well. But the 5% not doing well should not be construed as bad, should not be also come in the way of taking a decision that we are bad. So most of the time, the biggest mistake that we make, we form our opinion on the basis of the 1 or 2% failure rather than 98% success, 98% success.
Very true. And I think that's the personal philosophy as well as I know you. So focus more on the blessings that you have rather than the curses that you have. Focus on what you have rather than you don't have. And that is the success mantra even for investing and wealth creation. So thank you very much, sir, for all your insights and all your sharings today. And thank you everyone for joining us on this in this episode of Your Market Navigator. And from now on, since we have completed the entire cycle of our analysts, fund managers, and CIOs, and now CEO as well, we will be making this a fortnightly event, and therefore we will be having this session every fortnight, same time on Wednesday itself. So thank you very much for joining in once again, and a good evening. Thank you, sir.
Thank you, Bhavdeep, and I wish everyone safe stay and looking forward to great interactions.